Okay, coming back to you again, Jeff Benson, coming to you from Jacksonville, Florida. I am the program manager for Victor Builders Risk. And like I said earlier, today what we're going to talk about is renovation and remodeling projects. And if you really think about the world of builders risk, of course, the construction coverage, there's two major segments. There's what we call ground up new construction and then renovation projects. So what we're going to do is take a pretty deep dive into the renovation sector of the market. It is a phenomenal opportunity for agents to write a lot of business, but we just have to know the nuances of the risk. So we're going to cover the highlights today. And as always, if you have further questions after the webinar, you'll have all my contact information. So contact me anytime you want. So once again, Victor Builders Risk, we are a managing general underwriter. We underwrite on behalf of an A++ superior carrier. We love builders risk. We write business today in 48 states. We are in every state in the United States except Hawaii and Alaska. And we are open for business. So just remember that. What we'd like to do today is take 20, 25 minutes, go through the webinar. We'll cover the highlights and then we'll open it up for questions. So if you have any questions, hold them till the end and we'll go from there. So let's dive into this. This one kind of got my attention. This was numbers I didn't know. So in 2020, $420 billion was spent on home remodeling. Let that number sink in for a second. $420 billion. I was doing a little extrapolation based on the average builder's risk rates, and we're probably looking at, just in this residential remodeling sector, over $1 billion of potential premium. So that's why we're having the webinar today, and that's why, hopefully that's why you're here, taking the time out of your busy day to listen to me tell a few stories. So, and the other thing is kind of interesting, COVID-19 had a few changes on the market. I think if you thought about it, when we were all huddling in place, you looked around your house and said, you know, I think I need to fix this up a little bit. So that led to more remodeling. And then what happened is, as you fix up one room, you start looking at the other rooms in the house saying, I think I need to fix up the other rooms now too. So just kind of one thing led to another. And the other phenomenon we have right now is interest rates going up. It is having a negative impact on new housing. So I've always had this old adage, what do people do when they can't afford to build a new house? They fix up where they're at. So there's always this constant remodeling, renovation going on in the United States. And it's going on big time right now. So we got to figure out, what do we have to do to make sure we have the right coverage in place for these exposures that all these insurers out there have? This is kind of it in a nutshell. There's a lot of, what I'm going to kind of give you today is things that I hear every day as an underwriter. Agents call me with these questions. Sometimes they seem basic, but it gets a little tricky. A lot of times I even have to think about it. So first of all, the way we look at builder's risk, the major segment that we write is new construction, residential, commercial, and I have another term I use called ground up new construction. Seems kind of simple, but if you think about it, we're going to start with nothing at risk, and we're going to write a policy, a completed value policy for what this risk is going to be worth in the end. So it goes from 0 amount at risk to 100% complete. That's ground up new construction. They don't start with anything and then they build something. So then the next segment we're going to look at, and what we're going to talk about today, really is the next 3 blocks on the screen. Remodeling renovations only. So they're going to go in and they're going to do a room addition, or they're going to fix up the kitchen and the bathrooms, and they don't need coverage on the existing structure. They only need coverage on the renovations. Now I'm going to talk about how that can be a little tricky. You got to be careful, because a lot of times you have competing forms, one on the existing structure and one on the renovations. So today we'll focus on the renovation piece, renovations only. The next segment we're going to talk about, which actually has a lot of catches to it, is the remodeling renovations plus the existing structure. You have a contractor or an investor or an owner that's going to buy an existing building, a home or a small commercial building. They're going to renovate it and resell it. So we're going to cover each one of those exposures. You have the exposure of the existing structure and then the renovations you're going to put into it. And then the third piece of this, and this one's kind of simple, but it's the commercial tenant build out. You have a strip center and someone's going to build a little restaurant or something, a haircut place or something, and they're going to build it out. And all they need is coverage on the build out. They do not need coverage on the building. So we're going to dissect the last three of these in great detail now. One of the first things you got to get to in builder's risk or in all property insurance is making sure you have the proper valuation. So a lot of times as the values grow on these projects, one thing as an underwriter that we will request, and it's probably a good thing to always get, is the construction budget. Because a lot of times the insured can't really tell you exactly what's taking place. But if you look at the budget, it's going to list everything they're spending money on. And that's a great place to start. And the other thing that we're going to talk about today is called the scope of the project. And another word for scope is really just, what is the project? What are they doing? All the time I get these agents submitting stuff to me and I say, in your own words, tell me what they're doing. And I'm going to give you some examples in a few minutes. Just remember that this is critical, that we know what's going on, what exactly are they doing to the structure, and how much is it going to cost. So that's the first place to start when we figure out what are we going to write this policy for. Keep in mind two values on some of these policies: existing structure value and renovation value. So what is the appropriate limit? What do we write this policy for? First of all, we have an existing structure. And the way this is done is it's valued at the actual cash value of that structure. Actual cash value, replacement cost, minus depreciation. Somewhat subjective, so what I always say is if there's a doubt, pick up the phone and call your underwriter and say, here's what I got. I think the replacement cost is this. What do you think the depreciation is? And then you'll come up with a number and you come up with an agreement with the underwriter. One way around this to make it even more precise is to attach a stated amount endorsement. All that is saying is that you have worked out a deal with the underwriter as to what the value of this existing structure is. We do not write replacement cost on the existing structure. That would be very difficult, if not impossible, on an older building. So I would say, I like the stated amount endorsement. It's available. You got to call your underwriter and ask for it. But you can always go with the standard form, which is the ACV. And then once again, any questions, work it out with the underwriter. And the other thing that we look at is a lot of times we're going to know what is the scope of the project, what are they doing? Well, one thing I do is I look at the value of the structure, and then I look at the value of the renovations. For example, we have $1 million building, and you're going to put $5 million into it. You don't have to tell me that that's major structural changes. I can tell by the value. So things are just not right. If you tell me, oh, they're just doing interior trim fix outs, but it's $5 million. I mean, that's just can't be the case if that's the values are out of whack. So always look at the existing structure value and then the values of what they're putting into it. It starts giving you a feel for the scope of the project. We get asked this all the time: is it a historical building? For our program, we ask, is it on the historical registry? If the building is on the historical registry, well, we will not write it on our program. However, if it's simply in a designated neighborhood that's historical, but the individual building that you're looking at and submitted to us is not historical, we will entertain it. Now, keep in mind, I didn't say we'd always write it. We're going to look at it. But we do write older buildings. We just underwrite appropriately. And so all of you know, the older the building, the more the underwriter is going to ask questions and look at it, because it becomes increasingly more difficult to fix an older building that gets damaged. Pretty simple, right? So I would say as the building gets older, just be prepared to have more underwriting questions asked of that structure. This is a really important piece to understand. So we have two different types of policies in the property world. We have a vacant property policy and we have a builder's risk policy. So people are saying, well, what's the difference? Well, let's think about this. Vacant property is a building that's sitting there that has nothing going on, no construction activity, it's not occupied, there's no stores being operated, no businesses being operated, it's truly vacant. You do not want to put a truly vacant building on a builder's risk policy. The reason being is these policies have something called a vacancy clause or an ongoing construction clause. And what this says is, what ours says is that there's been no construction activity for 60 consecutive days. The coverage is greatly diminished. No vandalism coverage. We reduce all of the coverages. So basically, you would be doing a disservice to your insured if you take a vacant building and try to put it on a builder's risk policy. There's some very good vacant property programs out there, and that's where you need to go to place your vacant property. Now, just always remember that 60 days of consecutive inactivity would make that building vacant. I say that over and over again because agents forget that. Two different things, vacant property and builder's risk. So sometimes we get in a little, you submit a complicated remodeling project and you say, I need this quote today. Well, probably not realistic because first of all, I gave you a few points right now, but from an underwriting perspective, we're going to take a hard look at that existing structure. And what I mean is, if we insure an existing structure, we are taking that exposure immediately. So in a way, it's almost like permanent property. It's almost like a homeowner's or a commercial property policy. We are inheriting all of the risk in that structure as it sits today. So we have to, number one, determine, is it structurally sound? Is it in good shape? Is it valued correctly? We have to look at that building closely. We will look at online, we'll look at pictures of the building inside and out, and then we make a determination whether it fits our guidelines. So, I mean, I get a kick out of agents say, well, when they're done with this, it's going to be really nice. And I'm sure it is, but we're insuring it the minute you submit it or the second you submit it, and we bind it. So we're going to have to take our time to underwrite some of this stuff, depending on the values, depending on the scope of the project, the age of the building, the value of the existing building. So you got to give a little bit of lead time. I mean, we try to operate as quickly as possible, but on some of these things, but what I'm going to do is give you a few tips today that will expedite this process. Number one, when you submit an account, make sure you understand that this is not ground up new construction. This is an existing structure that's being renovated, for example. So when you're on our website, on our portal, there's certain cascading questions that only appear if you check existing structure. It's going to ask you certain things. So make sure that's filled out correctly, which is not hard, but sometimes agents get confused. And I hear all kinds of things like, well, it's a new addition to an existing building, so that's new construction. No, we have an existing building and we're going to add a room onto it. That is existing structure plus renovations. Always remember that. So first of all, get that correct. Second of all, make sure the scope of the project is easy to understand. You don't need to send a detailed architectural diagram and engineering plans, depending on the values. You simply have to, in your own words, tell us what the scope of the project is. They're doing an interior gut rehab of the building. They're replacing the windows. They're replacing the doors, the flooring. They're painting the walls. That is renovations. So that just tell us what I just told you. That's enough, as long as the values make sense. Another little tip. So sometimes we'll say they're putting a new roof on the building. Well, if they're simply putting new shingles on the roof, that is, not structural. That's minor. You just have to simply say that. Don't say just new roof. Say something like no changes in the load-bearing aspects of the roof, only putting on, a new covering on the roof. All right, that makes sense. That's clear. So I'm just giving you a little tips, but a lot of it is just being descriptive. Don't have to write a novel. Just tell us what they're doing. Hopefully that helps. Let's go back real quick. So some of the things that I hear about day in and day out is that, well, Jeff, it's not really structural because when it was considered major structural, we're probably not going to write it. We're going to decline that risk. If they're putting on a third story on a two-story building, that is a structural project, requires special contracting, special underwriting. We don't have that in our program. So if you're doing vertical square feet, adding vertical floors, structural. If you're retrofitting a building for earthquake, which means you're somehow lifting the building and doing stuff to the load-bearing aspects of the building, that's considered major structural, would not fit our program. But having said that, or if they're doing that, sometimes I'll say, well, they're buying an old building and they're going to put an elevator in it, in the inside of it. So they're cutting through load-bearing walls. That is structural. But now let's say we have a building and they're just going to cosmetically fix the staircase. All right, well, they're not doing anything structural. That's fine. So a lot of times you just have to give it some thought. If they're changing any load-bearing aspects of the building, that's structural. Doesn't fit our program. So that's one thing. But if they're just doing something that's not impacting load-bearing, we do have another category called minor structural. An example of the minor structural is what I said earlier. We're going to build a room addition onto the home, and yeah, they're going to have to cut a hole through the wall to get access to the room addition. That's okay. That's minor structural, as long as it's horizontal addition. Pretty simple. Makes that sense, right? So understanding that. So just you have to understand the difference between remodeling existing structure and remodeling only. You have to understand the difference between minor structural and major structural. And then the third piece is understand what a tenant build out is. There's no existing structure coverage, just a tenant build out. I think if you understand those concepts, it'll all start making sense to you. So what I would like to do, as I always do in the end of these, even though this was all about renovations and we are a market for all of this stuff, I will say our reputation in the marketplace is we have a very, very good coverage form designed to cover all the aspects of renovation type projects. We have very competitive rates, competitive commissions. We do ask underwriting questions. I've been accused of that before, but on renovations, if you think about what I said earlier, we are taking quite the exposure when we insure an existing structure. We are insuring that structure from the second we bind it, and we're on that risk. So we have to make sure it's structurally sound, it's in good shape, bottom line, good shape. If it's in good shape, we got no problems. And it's valued correctly, as long as it's valued correctly. So, but like I always finish these webinars, or a lot of what we do here is the ground up new construction pass-through risk. So once again, we always want to write this stuff too. So if you have buildings that are valued $1.5 million or less in coastal areas, or $3 million in inland areas, they are ISO protection class 1 to 7. You're not making changes to the coverage form. You should be able to enter that information in the website, quote, bind an issue within minutes. It should be very simple for you. And as I always say, if you ever have any questions, give us a call. So what I'd like to do now is open this up to questions. I would assume you have some questions. It's kind of a tricky little class of business that we write on these renovations. So Darcy, do we have any questions?
Hey Jeff, yes, first question, will you consider a gut rehab project?
I love that question. I get that question every day. So they'll say, yeah, Jeff, they're doing a gut rehab. Sometimes they'll say, it's just an interior gut rehab. Little tip, first of all, when you tell an underwriter rehab, sometimes it's a little bit of a negative connotation, but it's just a word, and I don't care about that word. But what I said earlier, I need to know what's going on with the building a little bit better than just gut rehab. So instead of saying they're doing an interior gut rehab, say, this is interior work only, flooring, painting, upgrading the windows, plumbing and electrical. That's all you'd have to say. Good to go. So if you just say gut rehab, I don't know what they're doing. So just give me a little idea of what they're doing. You do not need to write a novel. Do not need to send me a 75-page engineering report. Good question.
All right. The next question pertains to the pass-through risk guide. Says in the PDF it states if your client does not need an increase to the limit of automatic additional coverages, what is meant by automatic additional coverages?
Okay, I'm glad you guys picked up on that. So in our form, in all property forms, but in our form, let's just stick to our builder's risk form. We have the coverage form, the base coverage form, and embedded in that coverage form is what we call automatic coverages. We have 19 of them. You know, these 19 coverages all kinds of things, from property in transit to property temporary store to soft cost, and these have sublimits built in. For example, we build in $100,000 automatically. So when you write a risk in our program, you get our form, and in our form is this soft cost coverage. So those are the automatic coverages, and they each have a sublimit. So what we're saying on the pass-through is if you accept all those sublimits, and for the most part, they're adequate for the vast majority of risks, it will create a pass-through. Now, some of these you're going to need to increase them, and we're okay with that. But when you increase those automatic coverages, an underwriter has to look at it. So it causes an underwriter hold, and we have to look at it. Doesn't mean we don't want to write it, just means we have to look at it. So you think about that, 19 coverages, pretty much the most I've seen in the industry. We're very proud of our coverage form, but good question.
All right, next question. Does your policy form automatically include coverage for the owner, general contractor, etc.?
Yeah, so you have two choices when you write there's other choices, but you can either write these policies in the name of the general contractor builder, or you could write them in the name of the owner, investor, whatever they are. We will accept either one. I always recommend adding the other entity as an additional insured on the form just to make sure everybody's covered. But so you really, either one can be the named insured, the other one could be the additional insured. We're talking about builder's risk now, so their interest will be included. Our form is pretty broad when it comes to the interest of subcontractors. They're automatically included in the form. So if you really want to get deep into it, you got to go to the property covered. It's really all the building materials, labor, overhead that's built into the project. It's all covered. And so I guess the bottom line to your question is yes, we can go either way. They'll all be covered. Their interest will be covered.
Okay, next question. How do you handle a situation in which there are multiple primes? For example, if the general contractor has subs, another contractor has subs, and there's no contractual relationship between all of the primes, can you have multiple separate builder's risk policies?
All right, so that's an involved question. I mean, I'm gonna answer it on the surface, and we can probably dive into it deeper if that person, make a note of that person, Darcy, and I'll give them a call offline, because a lot of times it's like, do you cover the general, the subs of the subs, the subs of the subs? It gets a little tricky sometimes, but you only want to have one policy on a project. You never want to have multiple policies if you can avoid it on any policy, on any project. It gets very difficult. So I would recommend having one policy and trying to make the named insured as broad as possible so that all interests are covered. And that's what we do. But that does bring up another point that I left off earlier. So what I run into a lot of renovations, getting back to renovations, is people will say, well, we have a coverage on the existing structure. It's with the homeowners company. They got the homeowners. They're going to put a $500,000 addition onto it. So we only need a policy for the $500,000 addition. We've been known to take a look at that, but I would caution against that, because what happens is if you have two carriers on the same project, one on the existing and one on the renovations, what do you think happens when there's a claim? We've had some scenarios where these claims happen, and then now you got two deductibles, two different types of coverage forms, what's covered by who. It creates kind of a claim nightmare. So it's better if you could insure the existing and the addition on the same policy. But just a little tip. You can do the other way, but be careful, be cautious. Hopefully that answered your question.
All right. Next question is from an attendee who represents the contractor. So in a commercial renovation project, if the owner insists on using a master property policy to cover the project, what are the pitfalls to this approach, and why is project specific better?
All right, well, it kind of goes back to that, the two forms a little bit. But we do see that a lot. You'll see it in an example when there's like a municipality or a school system. They have a master policy and all of the permanent property is on one policy, and that's fine, leave it there. And then they're going to build it. I just had one the other day I was looking at, and they're building a new law library at a college. And I mean, they're going to renovate an existing building, but the building's already covered on the master policy. We're just going to be doing the renovation piece on our policy. And that's a pretty clean way of doing it. So, but I would always, on the renovation piece, I would like to have a separate policy just on the renovations. That's clear. Leave all the existing stuff where it is on the master policy, and then write a project policy on the renovation piece. Because there's, they're going to build a $5 million, they're going to renovate they're going to do $5 million of renovations to the library. So go ahead and write a $5 million policy just for the renovations of the library. And then leave the existing structure library on the master policy. Good question.
Okay. How is the policy affected if the general contractor is the one doing the remodel and renovation and also owns the property?
Yeah, once again, I mean, property, I think sometimes we get a little carried away with named insureds on property. It's all based on financial interest. So as long as you have a financial interest in the building or in the project, we can probably get you coverage on the form. So in that case, you might have two different entities. He's John the builder and John the developer, or John the owner. Maybe you list both entities as named insured, or one is a named insured and one's an additional insured, but they would be fully covered, based on their financial interest. So good way of doing it. Good question.
All right. Now this attendee says, it is common for a subcontractor to have an installation floater policy and also the owner to have a builder's risk policy. If a loss occurs and coverage could trigger under both forms, would your form be primary since it is a project specific?
That's a good question. Once again, I don't like two forms on the same exposure, but I can see where that would happen because the sub already has some type of installation coverage. But I mean, I could make a general statement and I get in trouble. I can't really do that. I'd have to look at the form to see which one was primary. So I'd have to really look at the form to make that determination. And I do see that happening. So that would be, make a note of that. I'll give them a call. We'll have a conversation offline on that too. I like that question.
All right, Jeff. It looks like that is all our questions for today, which is excellent because we are running up on time. So thanks, Jeff.
Well, thank you, Darcy, for running the show, and everybody that participated. I thank you. What an opportunity we have. There's such a vast market out there: renovation, rehab, existing structure, tenant build outs. I mean, there's so much of that going on. It always goes on. We like to write it. We just want to ask the right questions, get the right answers. So I really appreciate your time today. And as always, if you have any questions, I'm Jeff Benson. There's my phone number, my email, Donna Berry, our senior underwriter. Always remember the 800 number, 944-7472. So everybody have a great Wednesday, and I'll be talking to you soon. Take care.